And welcome. It's Saturday, and we're going to be talking about money. What a beginning of the year. We're just beginning to come out of COVID. We're just beginning to get back on our feet. We're beginning to open restaurants. We're beginning to open. We're beginning to get rid of masks. We're beginning to get back on our feet. And then strange things happening. Used car prices shoot up, and some used cars are priced higher than new cars. What's going on? We've got all these things. Go to the grocery store, prices are way up. I mean, everywhere you look, prices are increasing. And shortages. You order something, order a desk or part of a desk, and you order it in January, you can't get it delivered until July. I mean, what's going on? Add to that, now we have this war going on in Ukraine, an unprovoked invasion by the Russians into the Ukraine. So what a year it started to be, and what does all that say for investments? You know, when I look at it, I think about two great investors, Warren Buffett and Peter Lynch. Warren Buffett said, be greedy when everyone else is fearful, and be fearful when everyone else is greedy. Certainly, we're living in a time of fear. And I think about Peter Lynch, who over his 13 years averaged 29% per year, and yet people lost money being with Peter Lynch. In fact, I have a client who claims he lost money with investing in the Magellan Fund because every time it went down, he sold. Every time it was up, he was up. So what are investors to think about? What's going on with all this? Well, I thought today we'd take some time and talk about what's going on. Talk about inflation, talk about the Federal Reserve, talk about the war, talk about what's going on worldwide, and see where all this is going. So let's start with inflation. Sounds like a good place to start, in my opinion. There's two types of inflation. One is called a supply push, and the other is called a demand pull. What a supply push type of inflation means is that people are asking to buy things, and there's not enough supply to meet the demand. So people are willing to pay more and more and more to get what they want. Take the example of the used cars I mentioned. So new cars can't get all the parts. So there's a shortage of new cars. People want to get rid of their old car. They're willing to buy a used car, at least for a couple of years to get by, maybe longer. So they start bidding up the prices of the used cars because used cars are available. New cars are not. The chips aren't available. They can't get the new cars going. They can't produce enough new cars to meet the demand. So there's a shortage of supply. People are willing to pay for what is there, and what is there are used cars. So they keep bidding up the price of used cars to the point that even General Motors now is going to open a section, a part of their business, a subsidiary, to sell used cars. Is it a long-term strategy? You got to ask if it's really a long-term strategy. Does it really make sense? Is this a short-term or is this a long-term situation? Once you have chips, and there's any number of companies that are putting in chip factories, once you have chips and once you have all of the supply chain that you need to produce the new cars, are the used car prices going to hold up? Probably not. Probably used car prices are going to sink back to where they were before. And that whole concept of used cars as a subsidiary of a business is probably not going to make much sense. But it's not just in used cars. It's almost everywhere you look. When we came through COVID, what was happening is factories were shutting down. You couldn't get all parts. One of the examples that I've used before is the example of Boeing producing 737s way back when. And the first part that had to be ordered was the little latch on the door, but not even the latch. It was the slider in the latch. Because if you were manufacturing a plane for India it had to be written in India. If you were manufacturing a plane for Georgia, the country of Georgia, it had to be written in Georgian. If you were manufacturing a plane for Japan, it had to be written in Japanese. If China, Chinese, it had to match. In Spain, Spanish. In France, French. It had to match. But once you had that part actually produced, you could send that little slider to the company that made the latches, and that slider would go in the latch. And then the company that made those latches would ship it to the supplier of the doors. And the door manufacturers would slide that latch into the door, and then they would send it to the people that were putting together the lavatory. And then the lavatory, once it was put together, would send that lavatory to Renton to be incorporated into the fuselage. But the longest lead time was that little latch. Now think of what happened if that little slider, that company shuts down. It stops the entire production of 757s. That stops the entire production of 757. An incredible kind of thing. But that was happening all around the world. All around the world, and supply chains have been stretched out, just like the Boeing example I gave you. They would go into countries. They wanted to sell aircraft, new aircraft into countries. They would find offset work. So they would say to the people in the Ukraine or just into Germany, maybe not Germany, they weren't selling planes into Germany, but maybe they were selling them into a Middle East country. They would say, we will sell you these planes. You can offset some of the cost by manufacturing some of the parts. And so they had a supply chain that was worldwide. And Boeing wasn't the only one. Most companies had supply chains worldwide. Famous ones around that were making products in China, Apple and Hewlett-Packard, and the smartphone people making parts and making pieces in different countries, and all that supply chain had to come together to work. And all you have to do is shut down one piece of that supply chain, it breaks everything down. And that was what was happening during COVID, and that's what we're experiencing now. We're seeing supply chains that have been extremely limited, supply chains that are taking sometimes years to rebuild. Think about the chip industry and the shortage of chips. Demand has picked up. You've got people willing to buy cars and no cars to sell. And it's not just in that aspect. It's going to be in smartphones. It's going to be in so many different products where you have supply chain problems. And when you have supply chain problems, that starts to push up prices. And that is supply push inflation. And that's very different than demand pull. We've seen the supply push because of COVID. And as we get straightened around, as those chip factories get built, as other factories open up and begin to produce, as we begin to return to normal after COVID, some of the supply push inflation will begin to disappear. And that's why the Federal Reserve has not made much of a move to deal with the 6 or 7 or 8% inflation we're seeing, because so much of it is due to supply push. Now, there's some areas which haven't been, and that is in the petroleum industry, where it is actually a limit, and they're limiting the amount of petroleum into the market. And by limiting the amount of petroleum that's coming into the market as demand grows, prices are pushing up. And of course, the war in the Ukraine has had an impact on that as well. All of that pushing up price because supply is low. That could easily be remedied by Saudi Arabia producing more, or the OPEC nations producing more. But they have taken the idea that they're not going to produce more, they're going to keep price high. It seems to be defeating the idea of a growing economy, growing worldwide economy, but it's the idea they took. That's really different from demand pull. And as the world returns to normal, and it will over the next couple of years, it's not going to be the supply push inflation, which we see. It's going to be probably demand push, completely different aspect of what's happening. And that's the one that most people are talking about. They're talking about inflation, talking about the Federal Reserve printing money, pumping money into the economy. That is a factor in demand pull inflation. We're coming up to a commercial break. When we come back to commercial break, we're going to be talking, what is the difference between supply push and demand pull? Because the dangerous one, the really dangerous one, is the demand pull inflation. And that will be covering once we come back from break. So don't go away. We've got a lot more to cover. We're just getting the beginning of this whole thing. So don't go away. We'll be right back after the commercial break. Okay, so in the first part of the program, we started talking about this whole thing with where we are coming out of COVID. We got short supply chains, we've got problems with supply chains, we've got international issues, we've got shutdowns, we have so much going on, and then a war on top of that. So what's happening? So I talked about a supply push kind of inflation. That's where you have a shortage of supply and too much demand. But what about a demand pull? That's where you have too much money chasing too few products. And that's when you begin to get into this idea that the Federal Reserve is printing money. The Federal Reserve is printing money. How does that happen? It's not just a matter of rolling the printing presses and printing out more dollar bills and $100 bills and sending that money out to the bank or no. When we talk about the Federal Reserve printing money, it's a process. Think about this. When you go out to buy a bond or a stock, you write a check, and then you have to have the money in your bank account to buy the bond. If it's a $10,000 bond or $100,000 bond, you need $10,000 or $100,000 or whatever it is to actually purchase that bond. But the Federal Reserve is different. The Federal Reserve has an unlimited checkbook. They can just issue money. So what they do is they go out into the market and they want to buy $1 billion worth of treasuries. They simply make that order. They buy and hold on their books $1 billion worth of treasuries. And to pay for it, they issue a ledger, which is what you do when you have a check. Your check goes on your ledger. That amount goes into your ledger at the bank. What the Fed does is it simply makes a mark in the ledger of the person who's selling that bond, whether it's an insurance company or whether it's a brokerage firm or whoever's got the bonds, owns those bonds. The Federal Reserve simply adds $1 billion or $500,000 or whatever it might be to the ledger, to the checking account of the person or the business or the institution that sold that bond. And now the Federal Reserve takes that bond into their inventory and they hold it. And the Federal Reserve has done that. They have purchased $9 trillion of assets, treasuries, corporate bonds, municipal bonds. They've gone out into the market and purchased that. And they did that, number one, coming out of the Great Recession, they did some of that. But then coming into COVID, they did more. And then you had the programs of stimulus to the economy or keeping the economy afloat during COVID times. So the Federal Reserve has been out buying bonds at the beginning of COVID, back in March of 2000, or April of 2000, March of 2020, the Federal Reserve went out and began to buy corporate bonds and treasuries. And they bought that to create cash in mutual funds and in institutions, so those institutions had cash. And so those institutions could go out and buy stocks that were depressed. That's what the Federal Reserve did. They went out and they pumped in $7 trillion into the economy to do that by buying bonds, buying whatever it was, so that that money flowed out to the institutions. Those institutions then paid for to buy stocks to replace the bonds that they'd sold to the Federal Reserve. And that created $7 trillion of additional money into the economy. Right now, the Federal Reserve has $9 trillion on its balance sheet. $9 trillion. That is essentially what printing money is. Going into the market, buying bonds, primarily bonds, and primarily treasury bonds, but buying those bonds and bringing them onto the Federal Reserve balance sheet and making ledgers or adding that money to checking accounts at the banks where the sellers had their checking accounts. Simple process. So what has to happen in the long term is the Federal Reserve has all that $9 trillion on their books. And what they decided to do, they did it through quantitative easing, they did it through those programs, they did it through the stimulus during the COVID time, they did it through the stimulus, the CARES Act, and the other acts that have been passed during the Biden administration. They did all that in order to stimulate the economy. Then in 2017, before COVID, before we had this latest round of the Fed printing money, 2017, the Fed decided to begin to reduce their balance sheet because they had all that money that they had purchased and they had a significant balance sheet. They had purchased those toxic assets to create a market for them, to put money into institutions that held those. So they began to deleverage. They began to sell bonds into the market, a little bit at a time. And when I say a little bit, it was a little bit. Even though they held a significant amount on their books, in between 2017 and 2019, almost 2 years, all they got rid of was $800 billion. They only eliminated $800 billion for 2 years. At that rate, it would take 20 years to get rid of the balance. This time around, what will they do? It's going to be interesting to see what they do. But that brings us to a second point of interest rates. And we're going to come back and talk about the Federal Reserve and what they're doing because of inflation. But that's money that went into the economy, and it was not really inflationary. Think about it. Some of that money went to the airlines. The airlines were shut down. They would have, had the airlines not been shut down, had we not had COVID, they would have had those revenues coming in from flying passengers. But since they were shut down and they were on the ground, they didn't have those revenues coming in. Instead of that, it's the government that goes in and gives the airlines the revenues they would have received normally from flying passengers. So the money's not more money chasing more seats. It was seats that were not filled, and the government is simply filling those seats in a figurative way with giving them grants of money. It's not too much money chasing too few goods. The goods were already there. Those planes were just sitting there idle and empty. So the money that went in simply replaced the money that would have been there had we not had COVID. That doesn't create inflation. It doesn't create demand pull inflation. Had those planes been full and you allocate those monies to the airlines, that causes demand pull inflation. We're going to talk about what goes on in demand pull inflation because we're seeing some signs of it happening, not with the Federal Reserve and what the Federal Reserve has done, but we're coming back to that. But first I want to talk about interest rates in general, because I think you have to understand interest rates and the Federal Reserve's role in those interest rates, because we have $22 trillion worth of debt. The Federal Reserve can set the discount rate, it can set the federal funds rate, but it cannot set long-term rates. So where is the $22 trillion being held? It's important, first of all, to understand that, because interest rates are very low given historical norms. Historically, you'd expect to see the 10-year and the 30-year Treasury in the 4 to 5% range. Instead, it's around 2. Why? Because the Federal Reserve really does not control long-term interest rates. Although, as I say that, I think you'll see as I talk about this further, they do have significant control over long-term rates. But we'll get to that. $22 trillion worth of treasuries outstanding. $22 trillion. And the conventional wisdom is that China owns a lot of that. Actually, if you look at foreign governments only own a third of it, $7 trillion. Japan holds more treasuries than any other nation. They hold 1.32. China just holds 1.07 trillion. Not even 5% of our debt. Less than 5%. Japan a little over 5%. But $7 trillion are held in the treasuries and the central banks of foreign nations. So what does all that mean? It means that 3.6 trillion is held by mutual funds. Banks, insurance companies, and individuals have over half of it, 12 trillion. And then the Federal Reserve has 5.7 trillion. That 5.7 trillion was printed money meant to stimulate the economy, replace revenues that were not coming in. But the Federal Reserve, nevertheless, owns $5.7 trillion. And the impact of all that is what's impacting long-term interest rates. Long-term interest rates are a factor of what the market is willing to pay. Long-term bonds are sold on an auction basis. They're not rates that are set. It's whatever people are willing to pay for the bonds, an auction bond. So when you have demand from the Federal Reserve, along with countries, along with everyone else, it keeps the interest rates very low. And that's where we are. The Fed has a significant impact because they own almost $6 trillion, almost 30% of the U.S. debt, 25, closer to 25. We're going to talk about that impact after we come back from this commercial break, so don't go away. We're going to talk about interest rates. We're going to talk about the Fed's role in all of this. We've been talking about the Federal Reserve, about treasuries, about the total debt of the United States, $22 trillion in debt, $7 trillion held by foreign countries, of which Japan held 1.32 and China holds 1.07, 3.6 trillion by mutual funds, 12 trillion by banks, insurance companies, and individuals, and 5.7 by the Federal Reserve. Now remember, for banks, they can borrow money from the Fed at no interest rate, invest it in treasuries, and get a 1 to 2% return on their money for no risk whatsoever. And certainly some of that factors into it. But interest rates are low. And treasuries are sold on an auction basis, which means people come together, the Treasury puts out, says that we're going to do X billion dollars worth of treasuries this week, and people are willing to bid on those treasuries as to what they pay. And the highest bidders get the treasuries. And the Federal Reserve, for a number of years, has been in that market, has built their balance sheet to $5.7 trillion. So that's kept interest rates low because not only is the Fed there, but the banks are as well. What happens? What happens if the Fed begins to unprint money? Well, they started doing that between 1917 and between 2017 and 2019. They unprinted 500 billion. So they were going slowly. But when people talk about deleveraging the balance sheet, that's kind of what it means. It is what it means. It means that the Federal Reserve is going to allow their balance of treasuries to decrease. And when they do that, that means that either If they let them mature, the Treasury will deposit money to the Federal Reserve because they're paying off those. Or if they sell them in the open market, the buyers are going to give the Federal Reserve money that actually comes out of circulation. It's unprinted money. But what happens if that begins to happen? If that begins to happen, what happens is it has to be replaced. If the Federal Reserve were to suddenly say, we're not going to enter into the market anymore, we're just going to let this all mature, that removes that demand from the auction. And with that demand removed from the auction, what that means is interest rates begin to climb up on the long term. The Federal Reserve, when they have no long-term treasuries, has no control over the long-term market. But with $5.7 trillion, they have a significant control right now, and they can allow the Treasury long-term bond to actually increase. So right now, that's an issue. The Fed's not in a position of increasing the amount of money printed into circulation. The Fed is faced with the decision of unprinting money, unprinting $9 trillion. Now, the government, on the other hand, has all this debt, $22 trillion hanging over it, and they have to refinance it every year. And, well, for T-bills, they refinance every 30 or 60 or 90 days, for one-year notes every year, for 10-year notes every 10 years. It's not that the government pays that off. They have to go into the market, sell the bonds to pay off bonds that are maturing. And so you have a refinance constantly going on. That's the process of what we're going through. And the Federal Reserve has $5.7 trillion of Treasury notes, but they're also doing something else, because in March, they intend to raise the Federal Reserve rate to 0.25%, making it more expensive for banks to borrow. And now if long-term rates remain at less than 2%, the margin on banks is now going to begin to shrink by 0.25%. That's going to push banks to maybe not renew as much foreign treasury debt or U.S. treasury debt as they currently own. And they own a significant portion of the treasury debt. The banks own that, the insurance companies own that, individuals own that. They're going to begin to release some of that debt. And if the Federal Reserve also releases, what that does is it begins to push up long-term interest rates because you're removing demand. The other factor factoring into all of this is the Treasury is traded 24 hours a day, 7 days a week. It's the most traded security in the world. And when there's times of conflict and trouble, what happens? Central banks flee and go safety and buy the Treasury. So what we may be also seeing with the war breaking out in the Ukraine is we'll see foreign central banks buying treasuries, putting additional pressure on interest rates, pushing the rates down. And so the Federal Reserve may be an opportune time for the Federal Reserve to offload some of their debt, or banks to offload some of their treasuries to foreign countries. We will see. It's a big question of what's going on. And the Fed is playing a role. The Fed is not, as some people will say, the Fed has not lost control. The Fed is very much in control of what's going on. And the Fed can control long-term interest rates by releasing that $5.7 trillion. They directly control short-term rates. So they can have a significant impact on long-term and short-term rates. And that brings us back then to the question of inflation. Because if the federal government is no longer printing money and no longer going into the market buying treasuries, and instead is beginning to offload, that has the effect of taking money out of the economy rather than putting money into the economy. And that has the impact of reducing inflation rather than increasing inflation. Rather than a demand pull, we're getting a reduction in the pull because the Federal Reserve is dropping off. So the Federal Reserve is looking at demand pull inflation, and that's what they're looking at when they're looking at raising interest rates. Again, raising interest rates is meant to slow down the economy and reduce the growth of the economy. That's an issue that focuses on the demand pull inflation. And the Federal Reserve is focused on that. They're in control. They can control long-term rates, they can control short-term rates, and they're in the process of facing unprinting money. All of that works to reducing inflation. And so when we talk about inflation, as I talked about in the first segment, we're seeing a supply push because we've got a shortage of products because of the COVID, because of the supply chain. That's pushing up prices, but that is a temporary thing. That's going to go away as things return to normal. That kind of inflation is going to go away. Demand pull on the other side is also going to get pressure to feed back because short-term interest rates are going up, long-term interest rates are probably going to be going up as well because the Federal Reserve is going to be deleveraging. And how fast they're deleveraging, how fast the banks deleverage their treasury balance sheets is going to affect how much it has an impact on the demand pull inflation. But when you look at demand pull, it's only partly due to what's going on in terms of the government. The other part has to do with wages and commodity prices. Even though the Federal Reserve is not printing money, is in fact de-printing money, what we have going on is something of a reversal of the trend that began in 1973, where we began to get the earnings of the bottom half of wage earners not increasing given the rate of inflation, not increasing, and the money made by the top 1% increasing dramatically. And that then brings us to the other aspect of inflation, which is wages and commodities. Commodities growing because, again, it's a supply issue. Having a supply of commodities to produce, we've got a fully, as we come out of COVID, we have a fully operating economy worldwide, and that's going to push up commodity prices. And correction of income inequality is pushing up wages now. And that's going to put more pressure on companies to increase prices to offset wages. Usually, wages are offset to a large extent by productivity gains. But when you reach the point where wage gains are outstripping productivity gains, you get the equivalent of a demand pull inflation. And that's what we're facing. That's a slower process, by the way, than what we're seeing. Stay with me. We're going to wrap all this up and talk about it and what are the impacts for investors. So don't go away. We'll come back right after this commercial break and finish up this whole discussion about the Federal Reserve, about interest rates, about demand pull, supply push, supply chains, shutdown. So don't go away. And if you miss any of this, you'll find it on About Money. So we've been talking about the Federal Reserve. We've been talking about interest rates. We've been talking about this whole aspect of inflation and the world and everything going on right now. But the last thing I want to talk about in terms of inflation is long-term insidious inflation is due to wages and commodity increases. It's something that the Fed can't fight. It's something that the Fed can, in fact, fight by pushing interest rates way up and jerking the economy into a recession. We probably won't see that for a number of years. But what we will see is this insidious type of inflation we saw in the 1960s, 1970s. If you look at 1961, inflation was at 1%. By the end of the 60s, it was up to 6 or 7%, and then William McChesney Martin pushed up interest rates. It fell back down to around 4%. And then when Arthur Burns became chairman of the Federal Reserve, he lowered interest rates, and inflation took off. And of course, that was accompanied with OPEC and their oil prices. And in 1973, you got this division for income inequality that began to take place, that's continued for almost 40 years. Now it's beginning to correct. We're beginning to see that correction with wages pushing up faster than productivity. And as that happens, it's offset by companies raising prices. And that becomes this insidious kind of inflation, which is a creeping inflation. It took 10 years to go from 1 to 6% on that type of inflation in the 60s. Once it reached the 70s, it continued to accelerate and reached 15% or 16 or 17%. And the impact of that was between 1961 and 1979, the dollar lost 70% of its purchasing power. What you could buy for $1 in 1961 took $3 to buy in 1979. That's the kind of insidious inflation which we're probably going to face. And people are going to feel better because they'll see inflation dropping from 6 or 7% today down to the 2 or 3%, maybe 4% before it slowly begins to climb again. They'll think that we're under control with inflation. And in fact, what we're seeing is the erosion of supply push inflation and the beginning of demand pull inflation. So there are things you can do. There are things you can do even during inflationary times. But all of that leads us back to the original question, what in the world is going on? We've got coming out of COVID, we've got inflation, we've got a war going on. And that brings us to a subject we haven't touched on, and that's China, because the competition for the United States is going to be China. And all of that brings me back to Warren Buffett and Peter Lynch. Warren Buffett says, the time when there's fear, it's a time to be greedy. The time to be greedy is when there's fear. The time to be fearful is when there's greed. Right now, we're in a fearful time. Right now is a great time for investments and for hanging on. We're still in something I've been talking about for over 10 years, the super cycle, where 93% of the world's middle class is going to live in the emerging nations, not in the developed nations, but the emerging nations. They're going to be moving from subsistence to middle class to consumption. And I'll tell this story one more time about a client I had who was the plant manager of American Standard in Tianjin, China. 1,000 employees. They were manufacturing ceramic toilets, ceramic bathtubs, ceramic shower stalls. 1,000 employees, not one had ever seen, let alone used, a ceramic toilet, ceramic bathtub, or ceramic shower stall. Not today that most people buy lattes, they're driving cars, they're shopping for their stores in department stores, shopping for their food in supermarkets. Complete change. That's happening worldwide. It's going to continue to happen worldwide. And if you look at the Standard & Poor's and the revenues of companies in the Standard & Poor's, those companies derive over 50% of their revenues from overseas. That is a tremendous factor of what's going on. And for that, we're going to be competing with China. China wants to replace the United States as the world leader, and they have a full intent and plan to do it. I believe it's not going to happen. I believe that we can win this whole economic war, and I think it goes along with the actual military war we're experiencing. That seems to be ill-conceived. So we will see where all of this ends up. All I can say is there's a lot of people, or there were a number of people that lost money with Peter Lynch. Peter Lynch over 13 years had a 29% per year average return. And yet I have a client that lost money, and he wasn't alone in that, because when things go down, people tend to get fearful and sell out. And then when things are going great, they tend to buy back in when things are hot. It's the old adage, to make money, you buy low, sell high. In those terms, those people that lost money were buying high and selling low. The idea is we hang on through those periods of time. We know we go through these down periods of time. We've been through them before. We'll be going through them again. But the focus is on the longer term. And that's where investors need to be today. They need to be looking at the longer term. These things will pass away. It's a focus of understanding where we are and where we're going. And, for most companies, all of this is not changing very much of what's going on for a lot of companies. There will be a reallocation of resources when you go through something like we're going through with the invasion of Ukraine. There will be some reallocation of resources. When you're going through an inflationary time period, there's a reallocation of resources and a reallocation of investment themes and investment dollars and where you go with that. The idea is to be ahead of the curve instead of behind the curve. The idea is to understand what's going on and why it's going on and what the probabilities are for changes in what's going on. I've just given you in this program a high probability that the Fed is going to be de-printing money, unprinting money. They're going to be deleveraging, which is the opposite of printing money. They're going to be unleveraging, and that has an impact. That has a control on inflation, but you can't control wages, and you can't control, the Fed doesn't control that, and they can't control commodity prices. That's over and above the Fed. The Fed can deleverage, and they can force and slow down inflation, but they can't stop the insidious, small increases that will come with wages and commodity increases. For that, that's the investor that has to be aware of that, know what's happening and why it's happening, and be in those investments where it's going to be less of a shock, less of a reallocation of resources. That's what needs to happen. But understanding all the rest of this, it's critical and important to understand how it all relates together. It just seems so appropriate at this time to be talking about this with the war going on, with the economic war with China, the military war going on in Ukraine. It just seemed an appropriate time to bring this up. So that wraps us up for the day. I ask that you have a great weekend and a great week to follow. And I hope that things turn in the not too distant future for a very bright 2022. And you can find this and previous programs on YouTube by looking at About Money. That's where we are.
Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590.